I just want to get your take on what we're seeing, a second day of rebounds, at least in the futures right now. What do you make of that after that huge shock that we saw on Monday?
It's been a roller coaster of a couple of days, and I think what we're seeing in the market right now is realization that we possibly overreacted to the employment data on Friday. We're of the opinion that recessionary fears are sort of overblown. We don't see or expect a large recession at this stage, as opposed to just a slowdown, possibly a mild recession. We've got to remember that just 14 days ago, the economic headline was a GDP surprise to the upside. So Q2 GDP growth came in at 2.8%, well above expectations for 2.1%. So, I mean, we are certainly seeing a slowdown in the economy. We've seen that in the labour market. We've seen that in the weaker consumer. But this is the impact of higher interest rates finally taking their toll. Shorter cycle indicators are weakening, but that's precisely the point of monetary policy tightening.
So, Claire, I want to ask you.
The need for a recession.
If you're not concerned about a recession, are you concerned about just volatility and the slowdown that you're pointing to? I mean, as you look at a slowdown and just sentiment that seems to swing pretty wildly when it comes to these economic reports, do you have to protect against sentiment even if you're not really worried about a recession?
Look, we're focused on the fundamentals of our companies, and the sentiment macro is almost impossible to call. And what we've actually seen from this earnings season so far is that the fundamentals of companies are exceptionally strong. Earnings growth for the S&P is growing 11% this quarter. That's a significant step up from 6% last quarter. About 80% of companies are beating expectations. This doesn't scream a recession to us, and there will be volatility in the short term. There will be sentiment swings, but we think that as long as the company fundamentals are strong, then that sort of means that we're confident in the long-term prospects.
So when you're looking at strong fundamentals, you're looking to allocate capital to companies that can withstand an economic slowdown that you are concerned about and also maintain growth. One of the companies you're looking at, that's Meta. So forward PE of about 22, the S&P trades at about 21. I want to ask you, is that a GARP trade, growth at a reasonable price? Do you think we're starting to see the return of that trade?
We think that structural growth is certainly where you want to be in a slowing economic environment. You want to be in those companies that can deliver growth above the market expectations, but also that underappreciated component. So yes, I guess you could consider it as GARP. We don't really think about stars. We're more concerned about sort of the actual sort of company specifics. And what we think is underappreciated about Meta, I mean, just to clarify, we do see better opportunities outside the Magnificent Seven, but within the Magnificent Seven, Meta really stood out this quarter because they're in a minority of companies that are really deploying AI at scale and reaping significant benefits today. Very few companies are achieving that. A lot of investors, and we're hearing the consternation about where are the revenues from all of this AI investment, but we're seeing them in Meta's reporting today.
You know, Claire, a lot of talk about that yen carry trade. We don't talk a lot about currency here on this show, but something I want to point out is just the moves in the dollar. This quarter, dollar down just about 2.5%. I'm going to go to a note that was out yesterday. I thought was pretty interesting, since you mentioned the Mag 7. They say in part, big holders of the Mag 7, they should be lobbying for the Fed to sit on its hands because only with a structurally strong U.S. dollar will Microsoft, Alphabet, NVIDIA, and the rest attract the foreign and domestic capital needed for these stocks to recapture their highs. First time I've ever heard somebody talk about the Mag 7 being tied to currency. Agree or disagree that a strong dollar actually helps these companies and the dollar weakness is part of the weakness we're seeing in them?
Wouldn't assume that it's that it's a benefit, and we really don't think about FX when we're looking at these companies. We're looking at investing in these companies on a 3 to 5 year time horizon. We're looking at strong fundamentals. We're not trying to gain currency fluctuations at all. We do think that we see lower earnings growth for the Magnificent Seven going into the back half of this year, partly because of the depreciation of all this AI investment flowing through the income statement. But I mean, that's contributing to some fear factor in the market today. But longer term, we think that's quite healthy. Seeing a broadening out of earnings growth to companies beyond the Magnificent Seven that is not predicated on views on currency.